Hey, everybody. Thanks for tuning in. Today, I have a special guest. It is Phil Huber, Chief Investment Officer for Savant Wealth Management and author of the new book, The Allocators Edge. And we'll definitely get into that in a little bit. But he also has a great blog that we're going to talk about called Bips and Pieces. His titles are by far the most creative blog post-wise. Anything he titles, I always ask my own opinion for him. So when you see something like Bips and Pieces, you know there's a real big clever side to Phil here. But Phil, thanks for joining me on the show today.
Oh, thanks, Peter. I'm happy we finally got an opportunity to do this, and yeah, it's a joy to be here. I think for those that maybe don't know, listeners, like Peter and I have similar roles at different firms, but we've also become good buddies and friends over the years, just being at similar events and conferences. So yeah, it's exciting to be able to chat with you today.
Well, we are definitely going to talk about the book, but let's actually dive in a little bit to what you just mentioned. We have very similar roles. Our title is the same at a minimum. So Chief Investment Officer at an independent firm, at a registered investment advisor, overseeing billions of dollars. And a lot of people, I think, don't really realize some of the things that we do day to day. You know, I think a big part of our role these days is communication, in perhaps more so than past generations of CIOs. It's not enough these days to be good at due diligence and portfolio construction and overseeing group decision making, but now you also have to communicate. You do a great job of that. You're active on social media. You have a great blog. I mean, how do you feel like that role fits into your day-to-day work?
I think it's far and away the most important aspect of our job today. I think, you know, granted, there's differences with how we invest client money versus how you guys do at Plancorp, but there's a lot of similarities too. And I think when you come from a firm who espouses a evidence-based investment approach, where the focus is on long-term asset allocation and diversification and tax efficiency and mitigating expenses and frictions, like it's not exactly the sexiest way to invest your money. And so it makes communication about that, you know, even more important. It's not exactly the most it's not an investment approach that's necessarily predicated on good, cocktail party chatter. So we have to find creative ways to take these, what we know are very prudent and important investment concepts, but continue to communicate them in a way where they resonate with people, and also don't come across like we're sort of a broken record at times, because it can feel like that. So you kind of have to find different ways to communicate the same messages over time. And I think you've got to also communicate in a way where you're adapting the medium that you're using to different audiences. We work with hundreds, thousands of clients at the firm, and obviously we're not in each and every one of those client interactions. That's largely the job of the client-facing financial advisor. But when it comes to the investment concepts in particular, we do have a number of ways in which we stay in front of clients. And some of that's very broad, general communications that come in the form of things like podcasts, things like video, things like webinar, or even written communication on blogs, or client letters, things of that nature, but also social media becoming more important. So we're always trying to find different ways that we can craft our message and share it so that we're effectively reaching people where they want to be met. That, again, like you mentioned, that's a humongous part of the role we have as CIO.
And it's interesting because I think throughout your and my career, we have always seen these, what you might think of as famous fund managers who publish letters, and that's how they attract clients, and that's how they keep clients. That's how they keep people invested in the fund. And that's sort of bled down to our role. And you're right. You have to reach people on different mediums. I mean, here we are podcasting. We're also recording video. So depending on how you're watching us today, this is something you and I wouldn't have been doing a decade ago. And it makes me wonder, I actually was talking to the COO of a very large RIA not that long ago. It was a casual conversation. And he asked me, do I spend more of my time performing due diligence or speaking to the public, and which one do I like better? And I said, I actually love them both. And I know, Phil, you're a really analytical guy. We, I think, align philosophically like 95% of the way, which is pretty big. No one's like 100% aligned with anybody.
Right.
It's almost like religion. But when you're going through due diligence, I understand a lot of the way that you're communicating people and with writing blog posts and how you use social media. But when you're performing due diligence in your role, maybe pull back the veil a little bit. Talk a little bit about some of the practices that you have both day to day, quarter to quarter, year to year to help make decisions that you feel like are best for your clients.
Yeah, so I would say I feel very fortunate that I'm supported by a pretty deep bench of talent on our investment team. And so it's not just myself doing all the due diligence and research and making all the decisions. We've got I've got a director of investment research. Her name is Gina Beal. And then we have a team of 5 investment analysts that support us. And so I like to think of it as like I'm probably the last person on the team that you want monkeying around in Excel or in Microsoft or in Morningstar Direct. Like that's not exactly where, despite being an analytical person, that's probably not the highest and best use of my skill set. But it's great to have that team-based structure where we can have certain sort of generalist type activities that everybody shares, but also specialize the analysts in different coverage areas and different responsibilities. We also have our formal investment committee. So separate from the investment research team, Gina and I co-chair our firm's investment committee that has membership from several members of our executive team as well as a handful of our senior advisors as well. And so those are sort of the two areas that we focus. So the research team is kind of all the back end grunt work that goes into asset allocation modeling and researching funds and really digging into the weeds. And then the investment committee is the decision making arm where we want to have input not just from the research side but also the client facing side and the business side. So I think that works really well. We have some formal processes that we implement at the firm in terms of due diligence. One of those is called the quarterly Fiduciary review, and that's really more for existing positions that we have at the firm in our model portfolios and in any sort of size, where we're just on a quarterly basis reviewing those in a very kind of quantitative and qualitative way. Just to make sure we're staying on top of the things we own and there aren't any kind of yellow or red flags that we need to pay more attention to. And then we have another process called the annual fund review, which is just an annual process to essentially survey the entire investment landscape for the asset classes that we invest in and try to sort of re-underwrite what we're currently using, but also see if there's anything else out there that might be a better mousetrap or a more efficient way to get access to fill in the blank asset class. And so that annual fund review, that's not to say that we're only doing that type of thing once a year. There's conversations happening with many different fund managers and asset managers throughout the year, but that's kind of the more formal process that we have on an annual basis. So I think those are some good checks and balances we have to make sure we're finding the best funds for the best roles in our portfolios. And then having that investment committee structure, I think, is helpful as well, just so it's not just one person, making decisions, but rather a group of people collaborating on what we think our client portfolio should look like.
I'm personally fascinated by group decision making, not just in the investment realm. So I'm going to come back on that. But any fund providers who happen to be listening to us, I'm going to give you the inside scoop on Phil here with this question. But we are regularly, just like you, we are regularly speaking to our existing providers all the time. But there are thousands of funds out there, and you have to try to both be aware of what is out there, how they've changed over time, and what is new to market. I myself tend to hold meetings kind of batching them all at conferences. So I'll go to 2, maybe 3 industry conferences a year and make sure that I'm meeting with everybody. And that way I keep my pulse on it. The pandemic has made that really challenging. And I've always felt like that was a big efficiency gain because then I'm not interrupting my day and it makes it easier to keep track of. So for the fund providers who don't have Phil's attention, and you talk about this annual review, what are some of the things, whether it's digging into that annual review or just anecdotal examples of how you are looking at new companies that, you're looking to do due diligence with no real goal of trying to add, you're just trying to learn. What does that look like for you?
Yeah, I mean, there's no shortage of things that come into our inbox or that we see at conferences or just other interactions that we have within the industry that look interesting. There's always, shiny new toys out there. But, I think part of it is always going back to what is our firm investment philosophy? What are our core, tenets and beliefs, and sticking to those. And so I think when you have those closely held, philosophical beliefs, it kind of steers you away from 90% of what's out there. which is, I think, a good thing. So, I think, we get bombarded with emails and voicemails of people wanting to get in front of us because obviously we, given our role, that they want to, find who's the gatekeeper here and how can I make some inroads. So I think, on one hand, you want to be very polite with people, and so, but at the same time, we can't answer every email, we can't take every meeting. It's not a good use of our time. So I think what's helpful sometimes is if it's intriguing enough where, hey, we might want to take a look, like I would usually sort of assign that out or make an introduction to one of our analysts and have them take an initial meeting and kind of report back with their findings, and from there we can make a determination as to whether it makes sense to keep moving the ball down the field a little bit. Other times we have to be realistic about, again, like we're a large RIA, we allocate a lot of capital, so a brand new fund or an ETF with a really low asset base, it could be really intriguing and something we want to keep on our radar and continue to monitor, but you probably want to be honest with the provider, like, hey, let's keep in touch, let's keep kicking the tires, but be honest about the near-term likelihood of working together. We're a relatively slow-moving organization, and I say that in a good way, and that we're not trying to turn over the portfolio every year and constantly be shuffling funds in, shuffling funds out, changing our allocation here, increasing our weight there, lowering it there. Like, I think if we were doing that sort of activity on more of a regular basis, it would probably be a bad reflections of the prior decisions that we made. And so I think it's almost a badge of honor how little, model and portfolio changes we make in a given calendar year. So generally fairly modest. We're doing all the basic blocking and tackling stuff like, rebalancing and tax loss harvesting and things like that to just manage the overall portfolio. But in terms of manager changes and fund changes, it's usually, a low single digit kind of number of those types of things per year. And I think that's a good thing. And so, probably a little frustrating if you're a fund company or a vendor who's trying to gain our business. But I think for those that we've had multi-year due diligence processes with, that ultimately there has been an allocation made, they've seen like, hey, like this can be a very fruitful thing long term. You just got to have the patience and know that the way that large RAs conduct their due diligence is a lot different than perhaps the wirehouse or commission-based type model. So I think the wholesalers out there, I think the ones that really focus on the RIA channel, I think they get it and they understand that it's a long game and they need to take a more consultative approach as opposed to just pushing product and being annoying salespeople. And I used to be an annoying salesperson. That was my first job in the industry before I came to the RIA world. I was an internal wholesaler at a mutual fund company, so I understand the role, and I understand the quotas that need to be met for calls and contacts. So at the same time, I think as you mature in your role as a leader within an investment department in an RIA, you have to be more selective with your time, still be kind to people and treat them with respect, but also realize, hey, these could be learning opportunities for more junior people on your team, and let them take those meetings because they might learn more from them and gain more from them than you might.
It's so interesting you said that. That's certainly how I learned. Is the CIO at my first firm often put me in meetings with these providers, and I didn't really understand why. And now in my current role, I feel like that's part of the job that I do very well. The relationship building that's so important to due diligence that a lot of clients don't see, that you have to get not just the best products, but these are people with real resources who can help you and can also help the end client. One thing that also kind of made me chuckle as you were saying, I know there aren't that many fund providers listening to this. This is mostly, what would be our typical end clients. And there are a segment of clients who I think are disappointed by the lack of changes we make. Now, again, you and I have very similar viewpoints on the world, as do our firms. And so this is maybe not the experience for every CIO or for every firm, but I find myself sometimes in client meetings and they want to know why we haven't changed any of the funds in a year and a half or in 2 years. And I think when you go through conversationally the list of things that you're doing behind the scenes, you're often saying no 10,000 times for every one time you're saying yes. And maybe I'm kind of just throwing out random numbers here. But the other thing is that, as you said, slow moving because there is a group behind the decision. It is not one person. It is a team effort. And with groups come challenges. You mentioned you co-chaired the investment committee, and I mentioned I have a lot of interest just in group decision making as a whole. And I think one thing that I'm sure you see just like everyone else is that sometimes the quietest person is the one who should be speaking up, and the loudest person is the one who maybe should take a breath and let other people chime in. And, you also start to gain momentum and ideas just based on our herding mentality, whereas you want to try to make decisions as unbiased as possible. I'm just kind of curious, are there any challenges that stick out to you that you feel like you do a unique job of solving, you and team? I'll make sure to emphasize the team as well. Any approaches that you guys take to help navigate some of these group decision-making challenges?
Yeah, I mean, I think group decision-making challenges are always going to be there. I wouldn't for a second say that we have a perfect solution that gets rid of all the biases and things like that, but we try to be mindful about that. Like you said, there's in any group, there's going to be more vocal members, and then those that are maybe a little more timid or kind of quiet. And I think even, especially now that we're doing almost exclusively Zoom-based, meetings, that can, for the naturally more kind of, quiet people, they might become even more so in Zoom than they are in person. So I think it's, incumbent upon the co-chairs or the leaders of that committee, myself and Gina, that we, try to, if someone's being quiet, like, say, hey, like so-and-so, like, what do you think? Like, let us know what your opinion is. Try to force them out of their comfort zone a little bit. I think another thing that we try to do that I think is helpful is for that, I mentioned that kind of three, components of our investment committee, kind of executive leadership, investment leadership, and senior advisory members. That third part is a rotating role, so it's not like the advisors on the committee today that they're a permanent fixture there. Essentially, it's sort of a multi-year sort of rotation where it's good to just occasionally get some fresh blood in there, give other advisors an opportunity to be a part of the committee and see what that whole process is like. So I think that's helpful sometimes, where you get that new blood, new opinions, and they have their own experiences and views. So that's helpful to kind of spice things up a little bit. I think it's also helpful anytime, particularly when you're having some sort of vote at a committee meeting, is have people write down their answers before they provide them. That way, they're not just sort of like going around the room and, the three people before me voted yes, and I was leaning no, but I don't want to be that, that guy or woman. So, and so I think that's helpful, just to write it down and have them, put it up in front of the camera, is one way. I think it's always important too, just to have someone in any committee that is just sort of that natural devil's advocate, the one that even if they are generally in agreement, that they just like taking the contra side of the argument and maybe trying to poke holes in the pro case. So you always want to, you just try to identify someone like that and make sure that you have someone with that ability inside of a meeting. And I think you just, especially for someone in our seat, because we're leading the teams that are ultimately the engine driving all the due diligence and recommendations to these committees. Obviously, it's usually things that we want to see happen and go through. So I think you have to get used to, sometimes you're going to be disappointed, sometimes you might not be happy with the result, but that's why you have the committee. It's not your show, it's the firm, and we're trying to not just rest these important decisions that we're making on behalf of many families and institutions, not just rest in the hands of one person. So I think, a good example would be, like, we merged with Savant about 2 years ago, or just under 2 years ago. And part of that was we had our old portfolios at Huber Financial, my old firm. Savant had their own models, and the idea coming together was let's kind of build the best of both worlds. And so there was some change that came out from both sides in terms of, here are our go forward portfolios. So me being certainly proud of the portfolios we had built at Huber Financial, naturally I liked seeing things that we were doing that weren't in these Savant portfolios get added, but I also had to sacrifice a few things too, and that maybe I would have liked to see in, but understand that this is very much a give and take, and that like any negotiation, it's only a success when both, or like any good compromise, it's only good when both parties walk away a little bit unhappy. So I think that helps well. And
I think you would agree. Oh, go ahead.
I was just saying the last point would just be, like, I think it's important to just sort of move slow and remove some pressure from the decision-making process. So part of that is, like, give the IC members plenty of time in advance of the meeting to understand the agenda ahead of time, and give all the supporting materials, not, the night before or the morning of, but, hopefully a week or more in advance, so they've got time to kind of read through and digest everything and come prepared to actually have a thoughtful discussion on whatever topics you're going to be talking about, and also not make it imperative that you've got to decide right then and there at that first meeting when you're proposing something. Like, let it simmer a little bit, let the sort of emotions die down a little bit, but then revisit it the next meeting, or even 2 meetings later, depending on what decision it might be.
Yeah, I think that last part's really important because I know for me, we actually shrank the number of voters on the investment committee. We have voting members and non-voting members. And a lot of the research I saw is that once you eclipse 4 voting people, that more of the bias seeps in. And so we've had either 3 or 4 voting members, but a number of non-voting members that, like you guys, it rotates because another big part of group decision-making, optimal group decision-making research shows diversity of thought and how important that is. And so I do find that, like, I go around to the voters, but I also go around to the non-voters and just sit down and have conversations with them about what's going to be going on the agenda. And if there are votes, helping them really understand it and what resources do they need to make an informed decision. Because what you can't assume is that everyone's done their homework to the fullest extent. And I think the other thing I was going to comment on was you had mentioned when you merged portfolios between Huber and Savant. I think you'd agree that there's no such thing as a perfect portfolio, right? And so
exactly.
We know that really the only thing that matters is you can choose a portfolio that you can, for your clients, that they can stick with for as long as humanly possible. And, flip-flopping strategies is going to be crazy in the end. And I think you and I, again, we go back a ways. We talk a lot. I understand your investment philosophy and a lot of the process. And I think it's that philosophy that ends up driving the decisions. It's that guiding compass. And that really comes out in the book. And I guess, before talking about your book, in the vein of investment philosophy, I know you're a big reader. What are some of the books that you feel like have had the greatest influence on your investment philosophy?
Probably the most influential would be a book called Expected Returns by a gentleman named Antti Ilmanen. He works today at AQR. I think at the time he wrote it, he was at a different firm. But it's a very dense, sort of thick, almost textbook-like, book that covers, everything you'd want to know about different asset classes, different return and risk histories, portfolio construction from different types of lenses, and thinking of things both from an asset class standpoint, but also a factor standpoint. I don't know, I learned a ton from it, and I just thought it really kind of helped reshape my thinking in a number of ways. I would not classify it as beach reading, and nothing, no, and not necessarily something you're going to finish in one sitting, and probably not something I would share with a lot of clients, just because it is very technical. So I think for people in our seats, it's definitely something that is worth reading. Where I would say other books that come to mind that I maybe would be more comfortable sharing with clients, I would say generally like Larry Sweater. I've always been a big fan of his writing. He's written a lot of books, so it's hard to just single out one. But when I think about the beginning of my career, some of his older books were some of the first things I read that really gave me some of those kind of aha moments of like, oh, like this resonates with me. This makes sense to me. And so I've really just always been a big fan of Larry Swedroe. And then I would also just lastly point out a book called The Most Important Thing by Howard Marks, who's the founder of Oaktree. That really, again, I think I'd be comfortable sharing that with experts and novices alike. And what I love about Howard is just his ability to communicate what it means to be a behavioral investor, and that's what that book focuses so much on, is just behavioral traits that can make you a great or not great investor. And so that's certainly at the top of my list as well.
Yeah, those are great. I'll admit the unexpected returns. That one took me multiple sittings to get through. But yes, Larry's great. Howard Marks is great, as is his newsletter. So I'll make sure to link to all those in the show notes for any of you that want to check that out.
And now, one last thing I'll say there. This was kind of cool. Was so Auntie now works with Cliff Asness at AQR, and Cliff wrote the foreword to my book. And when I shared the draft with Cliff, I think he just wanted to have a few others within AQR read it too, just in advance of writing the foreword. And I know that he shared it with Auntie, and I had written a blog post about Auntie's book. Like I've been kind of a fanboy of this book for a long time, and so it was just cool for me to know that he actually read my book as well and shared some nice feedback. So that was a pretty cool thing for me.
That is super cool. And I had the privilege of reading an early copy of the book, but I never saw the foreword until you sent it to me a few days ago, the finalized copy. So I saw the book in an earlier draft form, and I read Cliff's forward, and it's in classic Cliff style with all the little footnotes. And, I think really cool to see someone that I think you and I both talk about a lot, great thinkers chiming in on the topic. And that's one of the cool things about writing a book. It's really hard, but it suddenly opens all these doors. You chose a very challenging topic for a first book. I mean, I think that you took on a subject that is big and that among some advisors is controversial. There are things about it that are so straightforward that people spend all sorts of time trying to learn. But when you read research papers, if you're not a very technical person, they don't make sense. And the book was so approachable. And I really think that this is going to be sitting on a lot of advisors' bookshelves for years and years to come. But given the background, we've talked a little inside scoop on what it's like to be a CIO. Maybe give us a little insight on what it's like being a first-time author, what the book writing process looked like for you.
It was tough. I'm not gonna lie. I had been writing a blog for 5-6 years. Writing a book is a completely different animal and just a different mindset. And it is very time consuming. So one thing I'll have to first off is give thanks to my wife, because without her support and her, again, this took a lot of time on weekends. I have a young daughter, and so it was a lot of weekends where she was kind of solo parenting while I locked myself in my office at home and toiled away at this. So without her blessing and without her support, this would have never really gotten done. So Christy, if you're listening, thank you and I love you. But it was fun and very, very fulfilling, but also could be very frustrating at times as you're going through it, because I'm sure you had similar experiences. Sometimes you're in that kind of flow state and you're getting through stuff. Other times you're procrastinating, and I always found myself kind of finding excuses not to actually be sitting down and writing by, like, oh, well, if I read one more research paper, one more article on this chapter, then I'll be more informed as I sit down and write. So it was very easy to print off a bunch of papers and articles and read through and feel like I was making progress, but no words were actually getting, typed onto the page. And so, eventually it kind of took some accountability, and again, back to my wife, a little bit of a kick in the butt from her, like, hey, like, you got to get this thing done. So she actually got me on like a good schedule, which I thought was really helpful, where at this point I'm probably like halfway through the book, but a lot of chapters like started but not completed. So it was kind of like, hey, like, I want to finish completed chapter every Sunday night for the next 5 weeks, because that's my deadline, was whatever date. And I'm like, oh man, I got a lot of work to do between now and then to actually stick to this deadline. So it's kind of like, well, here's what you have to do to get there, is finish these chapters. And so there was an accountability, and it was almost like it was fun for me to, like, on a late Sunday afternoon, be like, all right, here's another one. I can email to her, and it was kind of proof of, okay, I checked off another one. So it was kind of a fun thing to go through together. So the process took a while, like upwards of 2 years. It probably would have been shorter, but I had started kind of mid to late 2019. But late 2019 we had our first child. Also in 2019 we were in the midst of our negotiations to ultimately merge with Savant, which we did. But then with these large mergers, that's a lot of work and a lot of things that kind of take higher priority. So there was that, and then of course the onset of the pandemic. So there was a lot of factors where it kind of kept kicking the can down the road quite a bit. But it was really last fall of 2020 that I got back into it and kind of put my head back down and said, hey, I'm going to do this. I'm going to finish it. And here we are today. So a little bit behind schedule from where I thought it would be when I first signed the book contract. But nonetheless, the publisher was very supportive of my timeline, and I'm happy to be at that final stage today.
Well, you think it's the final stage, but now you got to do the marketing, which I don't think anybody told me about. I thought the editing stage was the hardest. And by the time, there's the writing stage, that's hard. The editing to me just blew my mind, because like you said earlier, it's not like writing 50 blog posts at all. It's very different to edit and read through a 800-word blog post. It's another to do 60,000 words, or I don't know how yours seems longer than mine, so I don't know how long yours was. But do you know how many words your book was?
I don't know offhand.
It's a weird question, I know.
Yeah, I don't know offhand, but I
realize I always know how long mine was, because I was like, oh my God, this is torturous as I'm reading through the editing part of it. But then by the time it's out there, you got to market it and get it in people's hands, and that's a lot of work too. But ultimately, you do end up, it's almost like a really fancy business card. All these doors start opening, and even, what the story you just told of having someone who you really admired, even reading the book, and then someone, writing a forward for you who you admire is really cool. I guess kind of pivoting hard here, I also came to learn from friends, family, coworkers, other advisors, people reaching out, that very few people finish the book that you write, which can be really disappointing when you put your blood, sweat, and tears into it. So for anyone who's going to go out and buy this book and, may not make it all the way through, where do you think is the most important part to focus in on? What's the most important message? Whether it's one chapter or if there's a concept that is woven throughout the book, where do you think people should focus their time?
I would say, it's a tough question because it's your baby and you feel all the chapters are of equal importance. But like you mentioned, most people don't finish most books. I think the data supports like people generally get through the first 3 chapters of like any book, then it sits on a bookshelf for a while, and I'm guilty of that as well with books that I've accumulated over the years. So I tried to put a lot of emphasis on those first 3 chapters, and the way the book is structured, so that the topic being alternative investments, which is, again, as you mentioned, is very, very broad, and my target audience is, I think it's primarily, not exclusively, but primarily financial advisors and what I would call professional asset allocators, those that are making investment decisions on behalf of other people or institutions. And really the format it follows is sort of the way I would think of it is 3 parts, and part 1 being the why behind investing in alternatives, part 2 being the what can you invest in within alternatives, and that section follows a past, present, future kind of progression, and then part 3 is the how, and how being how do you build portfolios and implement using alternatives, but also, and I think probably most importantly, how do you communicate alternatives to your ultimate constituencies, the people that are going to be invested in them? How do you get them as confident as you might be in alternatives, and what are some of the tactics and methods by which to foster a great client experience? And because I think a quote in the book that I have is, great investments are nothing if not paired with equally great investors. And so it's you can build a great portfolio on paper, but ultimately if the end client doesn't stick with it or can't stick with it or doesn't understand it, then it's kind of all for naught. So knowing that most people start with the first 3 chapters, I would just say probably those 3, because ultimately if those are the why behind everything, if you get through those 3 chapters and you're not sold on the why, then the what and the how are probably of less importance. But the what I would maybe caveat on top of that is I really am happy with that last final chapter where it kind of ties everything together from a communication standpoint, because to me that's where the rubber meets the road. And I think that's going to be probably for advisors that are reading this, that are sitting down and having those one-on-one interactions with clients, that'll probably be the most important to them. I love all the middle chapters, don't get me wrong. Those each tackle individual topics and asset classes within alternatives. That to me is like sort of the reference guide component to the book, where hopefully this sits on the bookshelf of a lot of advisors, and if they need to kind of bone up or refresh themselves on a particular area, that they can pull it out and within a few minutes kind of give themselves the talking points and kind of know enough to be dangerous if they're going into a meeting and need to talk about a certain fund or asset class.
Well, pulling on the string a little bit that you're mentioning, if a client can't stick with it, if it's perfect, it doesn't matter. You've worked so hard to build this portfolio and you put so much thought into it. And I think my experience in coaching clients with alternatives is that either there's an expectations mismatch between what those assets do, or there's just a simple misunderstanding. And maybe they're related because they see an asset lose on a relative basis over some period of time and they think, well, it'll do better when the market falls, and then it doesn't. And what they don't realize is that all that's important, and this isn't for all alternatives, but for many, all that's important is that it is behaving differently. And so, I would agree with you that last chapter is going to be useful to a lot of people, but maybe because we've kind of been diving into the role of the CIO so much here, maybe if you have any sort of anecdotes or situations where an alternative really rubbed clients the wrong way and what you did about it, I'd love to hear about that.
Yeah, maybe not specific to one alternative. I would just say in general, like the areas where challenges might arise between advisors and clients around the use of alternatives tend to come in maybe 4 areas. One being fees. So alternatives are just inherently more costly from a fund expense standpoint than what you can get in stock and bond funds, particularly index funds that are dirt cheap, almost essentially free in some cases. So that's one area that a lot of time is spent. Sort of how do you justify the fees here? How do you evaluate them in the context of what they're adding into the portfolio? Another is around just short-term performance. A third being expectation setting, which again probably is very closely related to short-term performance concerns. And then I would say fourth is just this perception of complexity. So on the fee side, one framework I've built out in the book is this notion of the 4 C's of investment costs, and that it's not necessarily always prudent to compare, hey, I can get an S&P 500 index fund for 3 basis points. Why should I pay over 1% for this liquid alternative mutual fund? It's important that we try not to compare apples, to oranges here when it comes to investment costs. It's just a different ballpark. So the way I try to think of these 4 C's, the 4 C's are capacity, complexity, craftsmanship, and contribution. So by capacity, I mean, an index fund of the U.S. stock market effectively has infinite capacity, and that's what allows those types of funds to offer very rock bottom low expenses. Something like, I'll just use an example like catastrophe reinsurance. It's a much more niche asset class. Vanguard can't launch a cat bond mutual fund and raise 100 billion in assets in it. They just want the space and the liquidity in the asset class won't allow for it. So something that's more capacity constrained kind of has to be a little bit more expensive to incent the provider to want to launch it and manage it. So that's one area. Complexity. The asset classes that are inherently more complex, generally there's less people that know how to manage them. There's sort of skill sets and knowledge bases that are in shorter supply, and so when there's demand for them, they can effectively charge a little bit of a premium for that skill set and that knowledge to navigate that complexity. Craftsmanship, this comes in the form of, there's a lot of probably very nuanced like implementation and design decisions that come into designing a fund and a product. Some can be very automated and are simple in nature for some asset classes. Others require a lot more thoughtfulness and this idea of craftsmanship. And so that lends itself a little bit to higher expenses. And then lastly, contribution. And by that I mean, what is it adding to the portfolio in the form of risk reduction, return enhancement, or diversification? If something is adding, a meaningful amount to one or more of those areas, then it's probably worth an additional fee. It doesn't mean that it's worth any fee, and there's no asset class so good that it cannot be made bad by a exorbitant too high of a fee. But I think the whole message there is that just because something is a modestly higher fee than a index fund doesn't always make it bad. It's just you have to evaluate the cost benefits like you do any decision in life. Sometimes a McDonald's cheeseburger will suffice. Other times you want to get a bone-in ribeye at a nice steakhouse. So it's not just cheap is good and expensive is bad. It's just there's a little more nuance to that conversation. Expectations is just this idea that I think a lot of advisors and clients sometimes maybe they lose the intuition around non-correlation versus negative correlation. I think we would love just something that went up all the time, but also went up in particular when stocks were down. Generally speaking, the things that are reliable to go up when stocks go down tend to have either very low or negative expected returns. And so you want things that are diversifying, but what that doesn't tell you is if you tell me the market was down today, I can't tell you what that asset class did, because if it's truly uncorrelated, then they're independent from one another. So behaviorally, sometimes that's tough, because it's like if the market had a really bad day, it's nice to go and look at your portfolio and say, oh, well, these alternatives went up, but that isn't always the case. It doesn't mean they're not worthwhile. And I think like any asset class, like stocks have gone through long winters. The S&P 500's had multiple kind of decade periods where it's had either negative returns or it's lost to cash on a real basis. And so like stocks, bonds, any asset class requires a long time horizon. Alternatives are no different. They're not a panacea. They're not a silver bullet that are going to make money in all environments. So you have to know that there are going to be some short-term periods where you're going to kind of hate owning them. And for us, it's all about kind of being willing to lose maybe more battles, but win the war, but have a higher degree of likelihood to win the war, by which I mean the more line items you have in a portfolio, you're more likely to have one thing that's going to stick out and be negative in any given period. But if that collection of risk premiums and assets in the portfolio is designed to give you better odds of long-term success, that's ultimately what we're trying to achieve. On the complexity side of things, I would say oftentimes we assume alternatives are more complex than they actually are. If you kind of strip away one or two layers from the onion, you often find there's a lot of similarities and commonalities to traditional assets, and things that are maybe perceived initially as alternative maybe aren't as much so once you kind of dig under the hood a little bit. I'll just use examples like things like reinsurance, like credit, like real assets. These are things that have existed for centuries. I think what's maybe somewhat novel about them is how they're being packaged and that they're a bit more accessible to more investors today than they were 10, 20 years ago. So I think it's this kind of idea of old wine in new bottles that we like to talk about with clients. And in terms of how we think about just adding things to a portfolio over time, it's this notion that we're always looking for ways to incrementally improve the characteristics of our portfolios. That could be looking for ways to improve returns, reduce risk, add diversification components. I like to use the iPhone as an example. The iPhone of today looks, effectively nothing like the initial iPhone that came out well over a decade ago. They do a lot of the same core functionality. You can call, you can surf the web, you can text, listen to music, but no one in their right mind is going to prefer the iPhone 1 over the iPhone 13. But you don't necessarily notice a lot of the small upgrades that happen along the way from iPhone 6 to 7 to 8. And so same with investing, same with building portfolios. We always want to do what we can to take advantage of the best raw materials we have at our disposal to build portfolios that are resilient across a wider spectrum of potential outcomes, and that are less sort of concentrated in one particular bet. Effectively, we're trying to make a lot of independent, unique bets in the portfolio. So I think the more that things become democratized, the more that minimums come down, costs come down, access is improved, it just gives us a wider toolkit with which we can build.
That's great stuff, Phil. Now, you are only my second guest on this show, and so I haven't really found the sweet spot of the types of questions that I want to ask everyone. However, as a CIO, I always find it interesting to hear how people invest their own money. So you don't get yourself in trouble with compliance, and you can go in as much detail or as little detail as you want, but what's in your portfolio?
Yeah, it's a great question. It's funny. I think I added a section in a later chapter of the book called "How I Invest My Money." I don't think it was in.
Oh, that was.
It was not in the draft. Exactly. Yeah, that was a later edition. Interestingly enough, Harriman House, who's the publisher, they actually have a book called "How I Invest My Money," where they have a lot of author contributors that talked about their own personal portfolios. The way I would describe it is, broadly speaking, from just an asset allocation standpoint, like. My family and I, we don't need any traditional fixed income. We're in our mid 30s, long time horizon, fairly high risk tolerance. So there's no traditional, core fixed income in our portfolio. Generally speaking, it's about an 80-20 mix of equity assets and what I would call alternative asset classes. That number can be a little bit skewed up or down depending on the inclusion of what is the largest asset in our portfolio, which is my equity in my employer. Savant. So that's a big balance sheet item, and I kind of view that as sort of private equity in a way. So at least today, there's no sort of other real private equity in the portfolio because I don't feel a need for it. I've got enough money in an illiquid stock. But if you strip that out and just focus on the kind of more liquid piece, the 80% of stocks is very much largely the same funds and weightings and kind of tilts to different factors that we use in our client portfolios at Savant. We're big believers in factor-based investing and having a bias towards value and size and profitability and momentum in the portfolio. Very much global in nature, about 60% U.S., 40% non-U.S. I have a handful of different funds that maybe sit outside of our core lineup. Generally that's kind of smaller, newer funds where maybe I know the person that launched it and have a good relationship with them and want to support them, or it's something that I want to kind of beta test but maybe isn't ready for prime time. So there is a little bit of difference with my holdings, but I also own all the same funds that our clients own in our models. In terms of the alternatives mix, I have a lot of the assets that are discussed in the book. There's an allocation to real assets. There's an allocation to catastrophe reinsurance. There's what I would broadly call alternative risk premium, which is kind of more liquid hedge fund type strategies. There's different forms of private credit in the portfolio. And then the fifth probably area would be crypto. That's probably an area that's a bit different than our average client portfolio. We don't have crypto assets in our client portfolios, at least not today. But that's an area that I've spent a fair amount of time on in the past several years, and feel comfortable with the risks and involved, and size it appropriately. But I feel comfortable holding that as a diversifier and something that I feel has high appreciation potential. So that's, I would say, at a high level, what's inside my portfolio. I do have a little play account where I buy individual stocks. Interestingly enough, I had not bought my first individual stock as an investor until about probably 2 or 3 years ago, which I think baffles. I think it baffles people, because I think most people kind of go the other direction, where they start with like individual stock picking and over trading, and then they're like, screw this, like I'm just going to buy index funds. I kind of started with index funds and broad diversification, and then eventually I was like, you know what, I just want to, just so I could say I did it, buy a few stocks. And so to me, that's entertainment. I'm not trying. I have no misconceptions that I'm the next Warren Buffett, or that I'm gonna generate some sort of significant alpha relative to the market. It's really just entertainment. There's companies I like and want to follow and learn more about, and I think having some skin in the game with them is a good way to stay engaged. So I don't try to kid myself with that. It's really kind of play money.
I have so many questions and topics that I think would be interesting for us to dig into, but you'll just have to come back. A lot of our friends know that you and I talked a long time about doing a podcast, so maybe that'll happen too, where we can dive into a lot of those. I got a big smile on my face about a lot of things. Just 2 more quick questions, because I know we got to stop here eventually, but I'd love to know what being a long-term investor means to you.
Yeah, I mean, that's a really nebulous term, and it means different things to different people. And I don't even know if I have a great definition. I like to think about, like, you've probably sat down with a lot of fund managers over the years that say, like, our aim is to outperform this benchmark over a full market cycle. To me, really long-term investing is multiple full market cycles. There's no definition on what a market cycle is necessarily and how long they last, but like, I look at all of our money that we have invested is for our future selves, are not even that, but just even beyond ourselves in our lifetime. We have 1 child today, but if we have other kids in the future, like, this is for them long term. There might be some other legacy needs down the road for any sort of charitable giving that we'll want to do, things like that. So I try to keep a very, very long term mindset. That being said, just because that's my view of what long term is, that might not be how the average client of ours views long term. We have clients that are retired or nearing retirement, where they might think of things a little differently. And even people that have long time horizons, like, it's one thing to say you're long term, but it's really, really hard to be long term when we're constantly, inundated by the short term. And so I think this notion of time dilation, where days can feel like weeks and weeks can feel like months in really tough times, like that's real. And so we're, as much as we are long term investors in how we manage money, we need to be very cognizant of managing the short term for people as well, because that's ultimately what gets them there in the long run.
One last question: where can people find you? You're all over the place. Everyone, there will be a link to all of wherever Phil mentions here, but also make sure to go buy the Allocators Edge. You can find it on Amazon now, but where else can people find you and follow you regularly? Yeah,
like you mentioned, the book comes out at the end of November. 11/30 is the release date, but you can certainly pre-order it now. You can find me on social media, particularly Twitter is where I'm probably most active, and my handle there is @BipsandPieces. Bips is BPS and pieces. You can find me on my blog, which is bipsandpieces.com. I try to write there pretty regularly. And then also I occasionally write for my firm's website over at savantwealth.com. So that's generally where you can find me.
Well, Phil, thanks again for joining us. And to everybody listening, just a reminder, you can always go to thelongterminvestor.com for show notes, resources, and a place to submit questions. Thanks, as always, for listening. And until next time, to long-term investing.